So the third part to building your own portfolio would be that of using options. And we've mentioned options a little bit in the prior two segments. And again, very few advisors / money managers implement options because of the complexity, the unfamiliarity with them. And I think in large part, the industry as a whole or investors as a whole misunderstand options. So we're going to hopefully resolve any confusion that there may be regarding options and talk about a specific formula that we implement at Iron Gate Global that you could also implement if you're doing it at home. Keep in mind, though, that's not a recommendation, of course. There's certain risks with options that we'll address as we go that if you don't understand them, they can be very risky. All right, so as we introduce options, understand there's two goals for an investor, right? Two goals of an investor. And those goals are, by and large, they want to enhance returns, meaning they want optimal performance, right? They want, in some cases, to outperform the S&P 500 or the MSCI All Global Index. They want to outperform these things, and so they want enhanced returns. While at the same time, anybody will tell you, well, I want to lower my risk, right? Or lower portfolio volatility. So those two things, it's a very, very, very popular phrase out in the world of investing today. It's called alpha. So if you combine those two things, the 1 + 2, that is alpha. That's what people are trying to gain. And to give you an idea of what we mean by portfolio volatility, from 2006 to 2014, this is a chart of the S&P 500. And you can see there's several time frames to where the S&P, and I've got them circled here, the S&P pulled back dramatically, the biggest being in 2008. Those swings in the market is called portfolio volatility. They're the swings down, right? The market falling down, but also volatility is also the swings on the way back up. Volatility works both ways, both bullish and bearish, and by and large, most investors don't want portfolio volatility. They can withstand a little bit, but they don't want a lot, right? In fact, we have a little quote on our website that says, if you are in or on the cusp of retirement, the last thing you can't have is a major hit to your portfolio like we saw in 2008. And I would say for those that are retired, for those that are getting ready to retire, no question. You can't have that kind of portfolio drawdown. And so the goal of this strategy and the way that we implement options, not just this strategy, but other strategies as well, which we'll mention, is to have a portfolio that is more like that red line that I drew. All right, that's just an example. But if you can, during the major down swings of the market, if you can outperform the market in that you lose less, people love that. People want that. That's what everybody wants, right? And I'll highlight with my mouse cursor a few of those time frames, 2008 and 2009. Now you can also see in this red line, which would be the alpha strategy, you can see that there's times where you underperform the market as well. And that is because if you want to reduce portfolio volatility on the downside by implementing these strategies, a lot of times you cap it on the upside. You can't have both, right? And so you can't have it both ways. So by implementing these strategies, you can see that there's going to be times when you underperform the market. Plain and simple. All right, I think that, and we'll speak to a few of those scenarios and maybe how to incorporate the strategy to where you can take advantage of as much as the upside as possible while still reducing risk to the downside. And that's the sweet spot. That's the alpha we're talking about. So what tools do we have at our disposal? There's a lot of different tools that we can implement. The modern portfolio theory that we mentioned earlier, the different theories that Peter Thiel mentioned, would have you diversify across different asset classes, fixed income, stocks, different, maybe real estate fits in there, maybe some sort of annuity. These are different tools that most people would look at to help diversify and reduce portfolio volatility. Well, we're talking about options here. We may or may not invest in fixed income. If we can buy it at a good price and it makes sense, okay. But we can accomplish a lot of the same things using options. And so there's three primary reasons why options are used. The first being protection, the second being income, and the third being speculation. And as we've mentioned before in several other videos and online on our website, we don't get involved with the speculative side of things. We focus on protection and income. All right. And so also keep in mind that as we do so, we're going to use some advanced strategies, and I'll introduce a few advanced strategies. If you don't know them, that's fine. If you do, then the rest of the presentation will make complete sense. If you don't, still stick around. You will still learn something. I promise. All right. So the first strategy we'll look at is covered calls, and covered calls is an option strategy where an investor writes or sells a call against a long stock or ETF for the purpose of receiving a premium. So anytime, it's like renting your stock. Essentially, if you have Amazon that we have in this example, and you say, you know what, I'm going to sell a June call, a June 280 call, and the current price of Amazon is $260. Essentially, what you're saying to somebody is you're saying, okay, you can buy my stock from me if it goes above 280, right? You enter into a contract. If it goes above 280, you go ahead and buy my stock. If it stays below 280, there's no advantage for you for having it, right? And so you receive a premium by entering that contract. They pay you money because they want your stock at 280 or above. And they may be in the belief that it's going higher, right? And so you enter that contract, you receive a premium, and as long as the stock stays below 280, then you're keeping that premium. Okay, that's how covered calls works. And so it provides income, and it also reduces the volatility on that underlying, not as a portfolio as a whole, but a covered call is just dealing with one stock. So it reduces the volatility on that stock. Let me illustrate. On a day when Amazon, if you can follow my mouse cursor here, is down $7.61. You're down $760 on the stock. All right, that's just owning 100 shares. You're down, the stock's down $761. You're down $761. The math makes sense there. Well, if I would have sold a call like you see in this example, then you know that when the stock pulls back or goes sideways or anything, in this example, pulls back $7.61, that the call option will make money. And so it's making you, on that particular day, one short call, one covered call is making you $183 that you can see here with my cursor. All right, so your net loss is reduced because you sold that call. You lose less. So what does this mean? Well, it means the stock goes up slightly, sideways or down, you make money on the premium. That's what that means. You also, if the stock goes up a lot, you cap your gains, meaning you'd have to sell it at 280, lose it at 280, which may or may not be what you want. Think about taxes. Maybe you don't want taxes. Maybe you don't want to sell the stock at that point. That's part of the risk in it. All right. You can also see that it reduces your loss and can increase your returns over time. That's the alpha we're talking about. If I sell an option far out of the money, there's a high probability that the stock doesn't reach that point. Well, I'm keeping my premium, right? So it can benefit me in that way. That's what that means. That's the advantage of the strategy, is that you can, if you see weakness in the stock, or if you want to sell an out-of-the-money call option, then you receive premium or income for doing that. So that's the benefit. And by and large, it reduces your volatility on that underlying. Okay? That's what it does. So let's look at a portfolio, and this is just an example portfolio. And when I posed the question while we were talking about this in Colorado, I posed the question, okay, if this is my portfolio, and this is just an example, there's no recommendations here, right? If this is my portfolio regarding covered calls, what can I do? What can't I do? And what's the downside? to selling covered calls. And a couple things were pointed out. Number one, you need 100 shares to sell a covered call. And a lot of these underlyings don't have 100 shares. I see 36, I see 40, I see 31. Some of them do. Some of them are at 108, 100, 300. So you can sell covered calls on some, you can't on others. For those that you can sell covered calls on, there could be potential tax consequences, capital gains, right? Especially if you've owned the stock for a long time and you don't want a taxable event. You don't want the risk of being called out. So there's that. There's also the time to manage all these covered calls. That's a lot of time, right? And I love the principle of covered calls being income and reduce the volatility you have on that stock by losing less on down days. But from the concept of looking at time and taxable events, when we look at our clients, and we've got to keep in mind those different things when we're managing their portfolios, especially the tax side. All right. So what can we do, and what strategy can we implement to still accomplish income and to still reduce portfolio volatility? And that comes down to a strategy that we call a bear call spread. And this is a friendly bear, right? Waving his hand there. He's a nice fella, nice furry fella. And what is a bear call spread, or a short call vertical spread? It's otherwise known as. It's a defined risk, which we like. Yeah, it's a defined risk trade. It's a defined gain trade. Anytime you have defined risk, you're going to have defined gain. All right. So we know going in what our max loss is. We know going in what our max gain is. It's also the way that it's implemented in the rules that I will share with you. It's also high probability in nature. It doesn't guarantee a potential return, positive return every time, but we have a higher probability of winning versus losing. All right. So what is it? Think of a covered call. Anytime you sell a call, think back to the Amazon example. We sell the 280 call. What if we sold that call? That creates what we call an obligation, meaning sell the 280 Amazon call. I have to give somebody my stock, the seller of the contract, the buyer of the contract. I have to give them my stock if the stock goes above 280, right, at expiration. So there's an obligation component to that. Well, in a short call vertical spread or bear call vertical spread, at the same time I'm going to sell a call, I'm going to buy a call, which gives me the right. And I'm going to break this down a little bit more. It's hard just to look at those two lines and to understand it without looking at an example. So I'm going to look at an example. And this is the alpha strategy, as we call it, right? This is the Russell 2000 small cap index that is correlated in a very similar way to the S&P 500. Okay, but it's looking at small cap stocks. And on this particular day, the Russell 2000 was down 16.5 points, or 1.6%. You can see right there, it was down 16 points. Also note the quantity is 0, meaning I don't own this index. In fact, I can't buy this index. I have to buy it. I could buy an ETF, but I can't buy the cash settled index that we're looking at right now. So the other thing that anytime the Russell 2000 is down 1.6%, most of the equities in your portfolio will most likely, because of the correlation with the S&P 500, they'll be most likely down as well. So your portfolio is going to be down 1.5%-ish, all right, on a day like this. Well, we know if we sell a call option, and in this case, we sold a June 1035 call. Now, the Russell 2000, and this was a while ago, but the Russell 2000 was selling at 982, and we sold a 1035 call. Now, think about this for a moment. Anytime we sell a call, just like the Amazon example, and the market is down, or a stock is down, in this case, the market, the Russell 2000, the market is down, then you can benefit, meaning you can make some money. And you can see in this example that you made, just on those short calls, you made almost $2,000, $1,700, right? Here's the problem with just that trade. just that in and of itself is great. The principle is great. The problem is you don't own the stock, the Russell 2000 stock. You don't own any. Quantity zero. And you're short calls. This is what we call a naked call position. This is very risky because if the Russell 2000 goes up to, say, 1,500, then you have to go ahead and give up the index at 1035, and you could potentially stand to lose technically unlimited, right? Because the Russell 2000 can go up forever. So unlimited risk if we just did that. So the question was posed, well, okay, how do we reduce that risk? Well, we're obligated to sell the Russell 2000 at 1035. That's what that position tells us, right? We have to sell it to whomever for 1035. Well, to reduce the risk, we're going to go ahead and buy some 1045 calls. Now think about the rights and obligation to that. If we buy some 1045 calls, we have the right to buy the index at 1045. So there's a $10 difference. If we are obligated to sell it to somebody at 1035, but we can buy it at 1045, then there's a $10 difference, which you could look at as your max loss, right? But at the same time, you received a premium for selling the 1035 calls. And so your max loss would be, and we'll look at a real life examples of the markets today, but your max loss would be the spread, that difference, the 1035, 1045, less your premium. Your premium received. And so on this particular day, you, instead of losing 1.6% in your portfolio, you actually made $650 on this position. And so what happened, right? Well, the spread made you money. Your portfolio lost less, which means you reduce your portfolio volatility. You still lost money. You just lost less. You are still outperforming the market. You lost less than the market, right? Which is very, very important. And over time, the spread should add to your overall returns in that, if you sell it every month or at certain times of the year, based upon the sector rotation and history that we showed you earlier, then you can add to your overall returns because you receive income for the premium of selling the spread, and you're reducing portfolio volatility at the same time. That is, my friends, that's alpha. That's alpha. Okay, so that's the foundation. How do we do it? Here's the rules for it. If you're writing these down at home, obviously at Iron Gate Global, we can do it for you. But if you wanted to do it at home, these are the rules. There's 4 components to any strategy. Number 1 is, what are you going to sell the spread on? The second one is, how do I enter? What's the entry criteria? What's the position sizing? Meaning, how many contracts do I sell? And then how do I manage the trade? And let's hit the first 2 right now. And the candidate selection is very simple. We're going to sell this on an index or ETF that's closely correlated to our portfolio. What does that mean? It means sell it on your benchmark. If you're closely correlated to the S&P 500, sell it on the S&P 500. If you want to sell it on the Russell 2000, sell it on the Russell 2000, right? If you make a portfolio with tech stocks only, sell it on the NASDAQ. Okay, so something that's closely correlated to your portfolio. The entry criteria is quite simple. You're going to sell 50 days worth of time, and you're going to sell a call, the strike selection. You're going to sell a call that with about a 15 to 40 delta. And I'll show you what I mean by that. I'll show you an example. And then you're going to buy a call further out of the money than the sold call. All right, so that's the strike selection. We're going to put this in play, a real example here in a moment. Okay, so that's your entry criteria. Go ahead and pause it, take a snapshot if you want, or again, we'll just do it for you, right? But the third thing is position sizing, how many spreads to sell. And this is very important, and I've learned this from experience. And by the way, this is the exact same thing that we used to teach advisors, exact same formula. So we know that it works if done correctly, okay? And if done consistently. So here's the steps to select or to calculate how many number of contracts that you're going to implement. Step 1, take the portfolio amount and you divide it by the index, the benchmark product, in this case, the SPX. So, for example, if we have a $500,000 portfolio and the SPX, the S&P 500 is at 2050, 500,000 divided by 2050 gives you 243 shares. Okay, now that's shares. Now, so there's one other step we need to take, and that's we're going to take the total number of shares, divide it by 100, and that tells you how many contracts. So in this case, 243 divided by 100 is 2 contracts. 2.4 contracts, rounding down 2 contracts. That's how you figure out how many spreads to sell. Okay, so I'm gonna bring up a paper money portfolio here. Give me just a second. This is a paper money portfolio using TD Ameritrade's Thinkorswim. Use whatever brokerage you want, right? But this has some paper positions in it. You can see that I could go ahead and sell covered calls on all these, or I could just sell a short call spread. So let's sell a short call spread. And I'm going to use the Russell 2000 as an example. A couple things you need to know. Okay, if I look at the net lick, which is the net liquidation value, or in other words, how much the portfolio is worth, it's worth $701,000. That's important for our formula. We'll call it 700,000. Okay, so I've got a portfolio of $700,000 that I'm going to sell some vertical spreads on. I'm going to go out 20 to 50 days, which would put us in April. And I've got a couple columns here. One is delta, one is gamma, one is theta. Also bid-ask spreads and vega. There's a lot of other things here. I'm only going to focus on this delta column. And I'm going to sell some calls. And so calls on the left-hand side, I'm going to sell those calls with a delta of 0.15 to 0.40. This one has 0.14. This one has 0.20. And the question was brought up as I've given this presentation a number of times. How do you know which one to sell? 0.15 or 0.40. In this case, we could go with the 1290 in April, or heck, we could go with the 1260. And my answer is the same every time. And here's it depends, and here it is. It depends on how bullish you are, right? If the market's been rallying and continues to rally, maybe you go further out of the money. If the market is a little bit more bearish and you're in maybe a sideways to downtrend, maybe you sell, closer to a 0.4 delta. If it's November through April, which are typically very bullish times of the year, maybe you sell a 0.15 delta, right? It just depends on how bullish you are. Okay, that's the bottom line. And so in this case, I'm gonna stick with let's stick with the 1290. Actually, let's go this just for example purposes. Let's go 0.2. Let's go sell the 1280. All right. So if we're selling the 1280, we could sell that by itself, but then of course we would be obligated and have no protection and be unlimited risk. In fact, if I were to sell that and it brings up this little box here, and I hit confirm and send, and it says max loss infinite, that's bad. All right, be careful. So instead of just selling the what do we say, the 1280, we're going to buy the 1290 in addition. And all I need to do on this software, and again, yours might be a little different, I'm going to go sell and I'm going to go vertical, and it's going to bring up the 1280, 1290, and it's going to be worth $1.95 or $195 per contract. That's the premium received. Okay? That's the premium received. That's all I do. That's picking the contracts. Now, how do I figure out how many I'm going to go ahead and sell? Well, let me bring up a calculator. And the formula was quite simple. We've got a portfolio that's worth $700,000. So let's see, $700,000. We take that number and we divide it by the value of the Russell 2000, which right now is 1238. Let's call it 1240. So, let me try that again. 700,000 divided by 1240 equals 564. That's 564 shares. We go ahead and divide that by 100, and that will give us 5.6 contracts. We can round down, we can round up depending upon how bullish we are. I like to get in the, especially as you very first start trading this and implementing this strategy, round down, right? No reason to be a cowboy. And if we round down, we're going to sell 5 contracts. And I'll go ahead and close this out on the left. So I'm selling 5 contracts for $1.95. Now let's take a look at the numbers. My max profit here on this order confirmation dialog box, my max profit is $975. My max loss is $4,000. All right. Now we will lose money, $4,000, if the stock, or in this case, the index, trades above 1290. That's our max loss at expiration. Now, some people, as I've presented this, have said that's horrible. Why would you look to make $975 when you're risking $4,000? Well, it's simple. It's a probability-based trade. It's got about an 80% probability of making money. So that's what we're looking at. Is we're looking at an 80% probability of it making $975 on expiration. It's a high probability trade. Anytime you're looking at those types of probabilities, you're going to be making a lot less than you're risking. That's the nature of the spread. I'm a high probability trader. That's what I look at. All right. The speculative trader would have the exact opposite, and that's not what we're going to do. All right. So keep that in mind. The other thing to this is you've got your break-even price, which is $12.81. We're selling the $12.80. We're receiving $1.95 in credit. Puts our break-even about $12.81.95. Anything below that, we're making money. Okay. Now, one other question that I get quite a bit as we implement this strategy is you're thinking to yourself, well, it's a $700,000 portfolio, and I'm only receiving $975 on this particular trade. And my answer to that is, and I've learned by experience, and think about your portfolio as a whole. In fact, let's close this out and think about your portfolio. If the market rallies in a big way, then you want this portfolio to be making you money. In fact, if your goal is to outperform the market, and there's a higher probability, just historically speaking, a higher probability that the market goes up than down, right? You want to outperform the market, then you need to be making money as these go up. And if the market goes dramatically higher and you have too many of these spreads on that we just crunched, too many of these spreads on, you're going to be underperforming the market in a big way. So we're not looking for home runs here. We're looking for singles. This is a single, right? The best hitters have hit for average, not for home runs all the time. We're hitting for average. This is a single, and that's what we're looking for. All right, so we don't want to sell too many of these for that reason. When our clients come to us and say, "I want to outperform the market," and we sell too many of these spreads, and then they're underperforming the market, they're not going to be happy, and neither will someone that's investing and doing this on their own. So you got to keep that in mind. Okay, so that's the spread right there. That's how you construct it. And that's why that formula is followed. All right. So the next thing would be, all right, how do I manage it over time? That's the next piece to this puzzle. So how do I manage it over time? Well, the trade management, we're looking at 3 different situations. If the underlying is trading below your spread, in between your spread, or above your spread, you need to do the following. If it is below your spread, exit 4 to 10 days before expiration. Exit once you've made 70 to 80% of your max gain. Simple as that. If it is in between your spread, meaning in between that 1280 and 1290, exit 4 to 10 days before expiration, and consider scaling out of your position. The last thing you want to suffer is max loss, and you do that by holding on. That's why you see that exit 4 to 10 days before expiration. Scaling out would be if you have 5 contracts, sell 2. Then sell another 2, and then sell the final one, right? The third thing would be above your spread, exit 4 to 10 days before expiration, and consider scaling out of your position. The same thing as you see above, for the same reasons, right? You can't suffer max loss on this particular position, which comes at expiration. That is the alpha strategy. That's what we implement. Again, this is why we implement it. This is how options can be used as part of your portfolio. Now, there's other strategies that you can implement as far as options go, and that we implement as for our clients. One is selling puts with the goal of income. One is collars if somebody has a very concentrated stock position. One is long puts, which we buy for protection in bearish markets, which we're not in now, but may come, certainly at some point we'll come across. And then vertical spreads, which you just saw, which income and produces income and reduces portfolio volatility. That's why we use options. It's a very powerful tool. All right. So if there's any questions on options, go ahead and email me at brett@iggga.com. More than happy to answer any questions. The final piece to the portfolio, which is not very intensive, that's why we included it with number 3, is that of cash. Why do we keep cash in a portfolio, and how much cash do we keep in a portfolio? Well, we keep some cash to open option positions each month as we sell options. That's the first thing. The second thing would be potential protection. If we need to hedge very quickly a portfolio, then we want a little bit of cash to be able to do so. The third reason would be new positions. Anytime we want to enter new positions, we're going to need some cash to be able to do that. And so that's why we keep cash. Now, that cash is going to be different depending upon the time of the market. The market dictates how much cash we have. If it's a very bullish market, like we're seeing right now, then we'll have 2, 3, 4, 5% cash, somewhere in that range. If it's a bearish market, you're going to see that cash expand 10%, 15%, right? That's how that cash component works. And some don't look at it as part of your allocation, but we do. And it's a very small part in some cases, but can expand depending upon the market. All right, so that is the cash component to your portfolio. So, and when all is said and done, after these 3 parts of building a portfolio that we have discussed, what did we do? Well, we discussed the 4 components to a portfolio, which we just finished with cash. We discussed sector rotation and gave you an update as to where we are in the cycle. And then we talked about options and how options can be used in a portfolio. All right, pretty simple. And of course, if you want to implement these for yourself, that's fabulous. If you want us to do it for you, that's what we do, right? So relax. We can take it from here if you so choose. And if you do choose to do that, then you feel free to send myself, Brett@iggga.com, an email. You can send Brian at iggga.com an email as well. We're your portfolio managers and more than happy to help you. There's my contact information if you need anything at any time. But I want to thank you for listening to this 3-part series. I hope you learned something. And we ran over this stuff pretty quick. And so, again, if there's any questions, if you want to spend some time on the phone or would like me to come to your city, more than happy to explore that opportunity as well. Just send me an email, Brett@iggga.com. Thanks, everybody. Have a great day.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@iggga.com or by calling 888-591-0334.